So good afternoon, and let me introduce everybody to this next in a series of our State Chamber Deep Dive series. And today we're going to talk about my favorite subject all the time, taxes. Although my wife always cautions me that nobody gets as excited about taxes as you do, Sloan, so be careful. So I'll try to be careful today and try not to get us in the weeds too much. But some important tax issues in front of the state right now, both short-term and long-term. We're going to talk about tax conformity with the federal code because that's been an issue today, and certainly about property taxes, and then also talk about broader tax reform with a longer-term vision. And I couldn't think of a better person to have partnering with me today on this than my friend Jim Vogel from the Platt Institute. The Platt Institute and Jim are very, very helpful as we take a look at tax policy, both short-term and long-term. And so, Jim, welcome today's presentation, and thanks for being here.
Thanks, Brian, for the opportunity. I'm looking forward to the discussion.
Okay, well, let's jump in, and Jim, I'm going to introduce the first topic, which is this decoupling topic a little bit, and then we'll be interested in your comments on that. And then we're going to do the reverse on property tax, and I'm going to have you talk a little bit about that, and then we'll do that. So let's start with this decoupling process and go from there. I'm struggling just a little bit with my paging here. So now I think we're fine. So let me talk just a little bit about this issue of coupling and decoupling and make sure everybody's clear on this. So many states in one way or another use the federal tax code as at least the starting point for the calculation of state taxes, and usually in the context of computing the amount of taxable income. Nebraska is generally viewed as what's called a piggyback state, which is, for the most part, we take most of our taxable income definitions, characterizations, and computations right out of the federal code. And so when the federal change is made to the federal tax code, I'm being told that I need to reshare my PowerPoint. Hang on just 1 minute. Bear with me. Okay, hopefully that's better. Sorry for that. So generally speaking, the advantages of this are that it creates a lot of efficiency, generally for taxpayers as well, in that we don't have complexities around calculating our state income taxes or creating new sets of documentation or record keeping during the year. Clearly has all of that advantages. And then secondly, from an enforcement standpoint, it gives us one set of audits whereby federal audits are conformed with state audits. So you're not under two different standards when you're audited on your taxes. And so those historically have been big pieces, but I also want to talk about it from a policy standpoint. And so I'm going to be a little bit Reagan-esque here, but from a tax policy standpoint, there's always three things that are just absolutely critical to tax policy. One is simplicity, and I think everybody would argue that we usually don't do as well as we should on the simplicity factor. But the fact of the matter is that the bulk of the taxes in this country are collected under a voluntary system, whereby people file returns and pay their taxes, and only a very, very small percentage ever get audited. To make that system work, the system has to be relatively understandable. It also has to be fair, and fairness in every study that's ever been done has a lot to do with people's willingness to comply in a voluntary compliance system. And so those two things go hand in hand in making any tax system work, whether it's your federal tax system or your state tax system. And then the third piece that's really important is the economic growth component. And the economic growth component is this, that from a revenue standpoint, whether you're talking about the federal or the state government, in the end, over the long term, the most important component in ensuring that a state has sufficient revenues to both fund its government operations, and that it's creating jobs, and that it's bringing businesses to the state, are this economic growth component. In many ways, a tax system is either helpful or a hindrance to economic growth. And without economic growth, ultimately you get in this downward spiral of ever increasing taxes to fund government spending, which drives more jobs and more companies away. So economic growth is really important, both in terms of the ability to keep tax rates at least competitive, and secondly, to continue to attract jobs and companies and businesses to your state. And so ideally, a tax code deals with that. When we look at the current issue that was in the paper this morning, Jim, I saw your editorial in the World Herald this morning. Thought that was pretty good. The question of, in the Federal CARES Act, which was this recent legislation from the federal government providing funding for pandemic relief, and I think the most notable thing that people are all aware about that was the PPP loans to businesses, which can be forgiven. But in that act, there were a number of tax provisions where the federal government was, in the course of the CARES Act, also trying to provide not only liquidity to businesses, and the vast majority of businesses throughout the country and the state are hurting from this pandemic, and a number of businesses are going to go out of business as we see bankruptcies of very large retailers almost every day in the paper. I think, and that's not even getting to other industries like hospitality, which has really been decimated. When you look at this bill, it created liquidity both in terms of loans to businesses, but also through tax provisions. And so there were a number, and you'll see on the left side of the page, there were some federal tax credits and rebates that really don't apply in the state. But then there was a number of provisions that I've only highlighted. There were probably 24 tax provisions at least in the CARES Act. I've only highlighted the ones that sort of have drawn attention as a potential targets for those who would want to raise more revenues within the state, because what these provisions do on a piggyback basis was they flowed through and they would apply at the state level as well. And unless the legislature acts to essentially decouple us from federal tax. Several of those, and I've indicated them in red, are additional ways to get liquidity to businesses during this time of difficult times. One was a limit on excess business losses that had been placed in place 2 years ago. And I'm going to skip down to number 4 below, which is increased NOL utilization. And the way to think about this is, when you think about tax policy, and I'm going to just give you my personal opinion and not necessarily chamber opinion on this, but my personal opinion from a tax policy standpoint is generally businesses or individuals should only be taxed on money they actually earn. And so that if a business earns profits in years 1 and 2 and then has losses in years 3, by the end of year 3, the amount of taxes they paid should reflect the net of that income versus those losses. But for a variety of reasons, Congress at times has prohibited the carryback of losses to go back and get the refunds that would be necessary to create that net number. So businesses are actually taxed currently only on their accumulated earnings over a period of time, and they require those NOLs only to be used forward. Or they may put a limitation on what an NOL carryback, how much of that could actually be used. Generally, as a policy matter, if you're dealing with this from a plain piece of paper, you would let NOLs be used in any year. But by allowing businesses at this time to deduct their losses, and many of these are the businesses that are hardest hit during this pandemic, all it's doing is providing that the taxes that they've paid over this period of time are consistent with the earnings that they've made, and it creates liquidity through the refunds they get in what is a really difficult time, and looks to be, based upon the pandemic, a difficult time for business, at least through the remainder of the calendar year. A second piece of this, which I'll identify in two of them, the increased charitable deductions and the 300 above the line deduction, which was intended to be to assist in creating more charitable deductions from non-itemizers. The charitable community is hurting during this pandemic significantly, but they're also significant providers of services during this pandemic. And so what Congress tried to do was enhance charitable deductions during this period, which both of these are pretty logical and they've been used in prior recessions. Decoupling in Nebraska would mean that Nebraska taxpayers wouldn't get the full benefit of that federal and state. And compared to other states that did not decouple, would make us less competitive and certainly would provide less pandemic relief. And so our principal concern with decoupling would be these benefits are really intended for some of the companies and businesses and actually ag as well, because a lot of the benefits go to ag. The businesses and jobs that really now are most stressed in our state. And so increasing their taxes at this point doesn't make a lot of sense. It would create cost and complexity for our state taxpayers because now you got two sets of accounting books and tax books that you'd have to keep. It would limit charitable contributions in our state. And with respect to net operating losses, NOLs, it's a timing issue. And so in the end, it just means that these losses would be used in later years and we would just push a revenue issue from this year to another year. And then finally, it would make Nebraska less competitive. So based on all of this, we've taken a position at the state chamber that from a tax policy standpoint, this just doesn't make a lot of sense to decouple on these provisions ad hoc. And it is ad hoc because if you were actually decoupled completely from the CARES Act, a key provision is the non-taxation of these PPP loans. And Jim, I'll let you talk about that. But I don't think anybody would propose taxation of the PPP loans. So Jim, thoughts about this? I know you guys have taken a position and you wrote an editorial on that today.
Yeah, overall, Brian, I think that decoupling would hurt these businesses at a time where we are trying to provide the most opportunity for them to rise from a crisis. And it's not just about providing them liquidity, it's also providing that liquidity so they can employ people. And families are dependent upon these businesses to stay solvent too. It's not just an urban larger business issue. We are going to be releasing some information. The SBA released some demographic information. 18 or 19% of the participants of PPP loans, there were over 43,000 in Nebraska, are from the ag sector. So it is about ag too, and the decoupling would hurt that important industry as well. So overall, we don't want to hurt these businesses that are trying to survive, and pitting property tax reform, which we're going to talk about in a second, versus conformity, I think is the wrong approach too.
Yeah, and I have not seen, based on data that's most recently available, but there is data that you can get out on the Department of Revenue website on business losses from prior years, and I think the most recent year out there is 2017. But it would tend to indicate, and this is only directionally correct, this isn't an exact number, that ag, for instance, would be 15 to 20% of the losses out there in any given year. And that's not surprising to anybody, given what the difficulty the ag sector has had in recent years. So understanding who is actually hurt with these provisions is important.
And some people are framing this as this is a $250 million tax cut for Nebraska businesses and the ag economy. We look at it as a different way. This would be a $250 million tax increase if we decouple. Some people are looking at it as a tax cut. And I think that's a better way to frame this. And especially in the time of this crisis when we are trying to provide the policies that are going to enable these businesses to survive and rise from it as fast as we can, conformity is critically important to the growth of the state.
And Jim, I'm going to raise one more conformity issue, and this is my federal background coming out again, which I apologize for. But one thing about tax codes is, and we're going to talk about this later in terms of the state's tax code, is they can get old and skewed over time as the economy changes and the world changes and the circumstances changes, and we've seen that. One of the advantages of having the system of being coupled with the federal tax system is on a federal basis, at least, what we've seen is every 15 to 30 years at least, and sometimes more frequently, the federal tax code undergoes a complete modernization. Certainly did in 54, did in 81 at the beginning of Reagan's term to stimulate the economy, then again in 86. That 86 bill created 20 years of economic growth, in which there was very much a cleanup of the federal tax system and starting to strategize on provisions that would drive an economy given the circumstances in 86. We just had it again a couple of years ago with the Trump tax bill was very much the same, recognizing, for example, the importance of the global economy now compared to what it was in 86. We get the benefit by being coupled of those provisions and all the work that goes in on the federal code to modernize our code. And so without them, we'd constantly have to be modernizing our Nebraska code, which is difficult to do. And I don't envy the senators who work diligently on the Revenue Committee to try to make that happen every year.
I agree 100%. And we have so many competitive disadvantages with our tax system. If we weren't continuously coupling with the federal tax code, it would even further not erode, but harm our taxpayers in the state.
Okay. Well, I've now violated my wife's rule that taxes aren't really that interesting, and we've just spent 15 to 20 minutes on decoupling of all topics, Jim. So I'm gonna push us to something that's sort of front and center right now in terms of Nebraska tax policy, and that's property tax. And I know that the Platt Institute has some views on this, and so I thought I'd hand this ball to you, and then I'll chip in at the end. That's
all right. Thanks for navigating the slides too. And I think it's important as we talk about property tax, where we're at today, to look on how we got here, and that's what these first few slides are about. As many of the participants might remember, in 1966, we didn't have a state or sales or income tax. We just had a state property tax. And in 1967, there was a constitutional amendment to eliminate that state property tax and replace it with sales and income tax, because back in the late 60s, they thought that our property taxes were out of line and extremely high and made the state at a competitive disadvantage. So idea number one in the late 60s, well, let's put a sales and income tax out there. I'll go ahead and hit the next slide, Brian. As you can see from the chart, as I said before, back in 1967, we adopted the sales and income tax to replace the state property tax. Attempt number two at controlling property taxes was 1981, where we lowered assessment values we increased them from 35% to 100%. And then in 1990, I believe, the TIOSA formula came about as a way to supplement school districts and handle the property tax issue. And then finally in 2007, the property tax credit fund was established as a way to provide property tax relief. And the point of bringing all these up, Brian, is that we've had several attempts over the course of many decades to address Nebraska's property tax. And I think the next slide is going to let everybody know where we stand today. So despite these monumental efforts over the course of the last 5 decades, Nebraska currently has the 7th highest property tax rates in the country. And we've seen the 6th highest valuation increases on the residential and commercial side by most recent numbers. So the cumulative effect of both those rates and the valuation increases has provided a significant burden on Nebraska farmers, entrepreneurs, businesses, and certainly Nebraska families. Go ahead and hit the next slide, Brian. So just circling back to TIOSA and the Property Tax Credit Fund, we created the TIOSA formula, yet now school districts still make up 60% of our property tax bills. We've even dropped the levy rate from $1.10 to $1.05 since the creation of TIOSA. And then the Property Tax Credit Relief Fund, which was created in 2007, we spent on an annual basis $275 million towards that relief program, shifting sales and income tax to that credit fund. And our point being at the Platt Institute is that you're shifting funds, number one, but number two, it doesn't limit property taxes at all, it doesn't decrease rates, and it doesn't do anything for valuation limitations. Go ahead and hit the next slide, please. When we have surveyed Nebraska taxpayers, we found that 62% favored both limitations on property tax rates or valuations. So the demand is out there. Unfortunately, that's not what the reality of the landscape looks like in Nebraska. And quite frankly, I can sum it up pretty easy that valuations have increased significantly over the last 10 or 15 years. And by doing so, each political subdivision reaps a windfall that they're not expecting. And generally the case has been they don't use that windfall to lower rates, and therefore is contributed to the high tax landscape that we're in today. Go ahead, Brian. I'm going to walk through this slide and then maybe walk through LB 1106, which is the current bill that the legislature will be debating on January or July 20th when they come back. What we would like to see from a tax reform standpoint, it's not just property taxes. You and I are going to talk about this a little bit later, Brian, I believe. Step number one is to eliminate some of these sales tax exemptions with the exception of business inputs. We're not the same economy that we were in the 60s. Only 3 out of 8 services are currently taxed from a sales tax standpoint. That's how other states like North Carolina, Utah, Indiana have fundamentally reformed their tax system. So that would be step number one. That's currently not part of any bill that's being debated in the legislature right now. Second policy point, stronger taxing limitations on these political subdivisions, specifically looking at schools. If you look at the growth of state spending on a school standpoint, you can't ignore that when that landscape when considering how we got to these high property taxes. Certainly option number 3 is available to them as well, and that's providing them another source of revenue on a local level, possibly local sales tax by vote. And then the final item on that slide is to provide a base amount of state funding per pupil. That's what we call foundation aid. That's in LB 1106 right now. That's the end of my slides, I think, Brian, and it might be just good to talk about right now what 1106 does. LB 1106 provides foundation aid to each school district. The money from the state then is used to lower the assessment ratios on ag land from 90% down to, I believe, 75% to 55%. And for residential and commercial, it takes it from 100% down to 87% over 3 years. And that's at the school level only. And that's generally the mechanics of LB 1106. There are some spending constraints associated with that bill, which is why you have seen the opposition coming from the public education lobby, and quite frankly, why I think the 33 votes aren't currently there. We hosted Senator Linehan this morning on our Platt Institute webinar. We talked at great length about LB 1106 and the prospects of it moving forward. And I think that with the pandemic and certainly with the coupling with the tax code and the need to get the incentive package LB 720 over the finish line, we've got a tough push ahead as it relates to property tax reform.
Hey, Jim, just to conceptually, you and I have dealt with and worked on tax legislation many times before this year, and sort of one of my fundamental beliefs on the income tax side is the clearest and most successful path to making us competitive on the income tax side, and we're not competitive on the income tax side, at least in terms of top rates right now either, is to generate economic growth and then take portion of that economic growth to lower rates and take a portion of that economic growth to fund whatever the appropriate increases in spending are. But there has to be some sort of spending restrictions, at least in terms of the growth of spending, not necessarily cuts, but how fast we grow.
Right.
The economy's only growing at 3%. We can't grow government spending by 6 or 7 or 8% a year, or even 5%. that's sort of how I view the income tax side, is that we ought to be taking economic growth every year. And I should remember too, and making the other piece of this is make sure our rainy day fund is where we want it.
Sure.
A piece of it ought to be for rainy day fund, a piece ought to be for lowering rates, and a piece ought to be going to making sure that we are spending in those areas that we need to spend, but at an appropriate growth rate. When I look at property tax, and I looked at your earlier chart, it's clear property tax, there's a spending side to this, but the equivalent of economic growth is in property tax is valuations. But over the years, valuations have skyrocketed. And mechanically, you and I worked on bills before on the income tax. I'm thinking on the property tax side, really as those valuations went up, if I had 20/20 hindsight, we should have been taking a piece of those valuations and reducing property taxes with that. A piece go to defined spending increases, and a piece go to local rainy day funds if that's appropriate. But am I right in that sort of analogy that valuation shouldn't automatically 100% go to additional spending?
100%. And as I talked about just previously, I think that's been the largest catalyst for why we are where we are right now on property taxes, is the windfall that's associated with valuation increases is being spent. It's being spent above and beyond budgeted expenses. And we've got to have some sort of trigger or mechanism that's mandated by the state that if we have large valuation increases, that's given back to the taxpayer and the rates are lowered so the burden doesn't increase. And if I'm an ag property owner, especially prior to 5 years ago, they're largely paying the brunt of these increases because of the land mass. But now we're starting to catch up on the urban side of the state too. As I mentioned before, we've had the 6th highest valuation increases in the country. And this is a cumulative landscape that just can't be sustained without hammering Nebraska property tax owners across the state.
So Jim, I'm going to have to do this, and just to make sure that everybody knows that sometimes you and I disagree on stuff. So the sales tax exemption piece up here, and it's not part of 1106, so it's not relevant to this year's debate. And I think I actually do think we agree, but it's probably just in the context. We have opposed in the past sort of ad hoc sales tax exemption repeals, picking 5 or 10 or 15 or 20 to fund a specific property tax bill, and probably would do the same if it were an income tax bill. That sales tax exemptions, there's a lot of money in sales tax exemptions, and I think of sales tax exemptions primarily in about 3 buckets. One, that are just fundamentally fair as a matter of tax policy. And so inputs in manufacturing, to me, you shouldn't tax them twice. So you should only tax those goods at the end. Another one for me that's sort of fundamentally fair is trade-ins. Trade-ins of business property, or even trade-ins of personal property, where if you buy a car, you trade in your old car, you shouldn't have to pay sales tax on all of that twice, at least the value of that trade-in. Then there are items that are competitive. So if we were to eliminate a sales tax exemption, but South Dakota, Iowa, Kansas, and Colorado all had that exemption, we would simply drive all that business to those states. And so one of the things you have to look carefully at is make sure we do that. And then you look at everything else and take a look at it. But I would tend to only open that Pandora's box if we were actually doing a full-scale modernization of the tax code. And I think that's probably the nuance in terms of the context. What I liked about this year's property tax bill is it went to the heart of trying to find a compromise between allowing additional spending within limits, but taking excess revenues that we were getting from growth and turning those back into tax cuts. Your thoughts?
Yeah, I don't disagree with the 3 things that you outlined. As I look at Nebraska's tax system, we are, though, a tax system of carve-outs, depending on how successful you have been over the last 50 years of getting yourself carved out of taxation on a sales tax standpoint. And so you've got to look at a fairness aspect. You've got to look at the fact that we only tax 3 out of 8 services. We're picking winners and losers, and we have been for 50 or 60 years. And that's not a way to modernize your tax system as well. And I agree with you. I think that if we're going to do this, move towards the direction of expanding the sales tax space, it has to be done in a fashion where we are making a significant step to modernize our tax system. North Carolina, I think, is the prime example of a state that has done that and now seeing growth because they've lowered their income tax and made their state more competitive. I always talk about what is political reality, and getting to 33 votes in Lincoln is certainly critically important. We don't have the political will to go in and make the necessary spending cuts to generate the revenue that we need to modernize our tax system. And so the most logical, from a policy standpoint, option that's on the table is looking at some of these carve-outs. And it's shifting some of the burden to folks that are paying now for some services and goods. But the other way of looking at it is it's eliminating some of these carve-outs and some of these winners and losers that we've been picking along the way. And we need to modernize our sales tax system and use that funding towards overall fundamental reform.
So Jim, I took us a little far afield there and got us ahead of ourselves, but coming back to current day, I mean, I would say it is really essential this session of the legislature that every effort be made to find a property tax solution for a couple of reasons. One, because when you looked at that number of where we stand among the states in terms of property tax, it's not a good thing to be paired with Rhode Island and New Jersey and Illinois from a tax standpoint. We're in the top 10 of property tax states, and that makes us very uncompetitive. But secondly, this is, property tax inevitably is tied to the debate on incentives and other economic issues in this session. I think we view it as essential that we try to find a way to find an appropriate way forward on property tax this session. And it's also important, I'll talk about this in a minute, but that we need to modernize our tax code in a much more fundamental basis. But we need to move forward on this debate this year to set us up for that conversation. Your thoughts?
No, I mean, the property tax issue is not going to go away. I hear it as I travel the state. It's the number one priority I hear, other than workforce capacity and finding talented people to fill jobs. Those are the number two issues. And from a practical standpoint, Brian, we've got to address property taxes at some point so we can move on to bigger systemic fundamental relief and other issues that are important to grow in the state. And from a practical standpoint too, I think with the rural-urban divide that's in our legislature right now, if we want to look at the priorities of LB 720 or some of the other things that might be tied in a package, I think that we have to check property tax relief off the list this session.
Okay, so we're both on board with trying to do everything we can to make that happen. I assume that there will be left turns and right turns along the way, but I assume we both feel that becomes getting these bills out of this session becomes important to setting up the next and going forward.
Yeah, I agree. And one final thing that we've been pushing at the Platt Institute, certainly conformity on the CARES Act is going to have an impact on Nebraska's budget. What we've been working with Congressman Bacon on, and there's bipartisan legislation now in DC, both in the House and the Senate, is have some flexibility with this CARES Act money so we can backfill some of these revenue losses as it relates to conformity or COVID-related budget decreases so we can avoid property taxes going forward. So that might be an answer that is available to the legislature to offset some of the decreased income because of conformity.
Well, let me turn to the next subject, and we're going to leave some time for questions and answers at the end of this, Jim. But let me turn to the next subject, which is near and dear to my heart, but more long term. You opened this conversation with an old copy of the Nebraska Constitution. And in many ways, our tax system was built on an economy that doesn't exist anymore. An agrarian economy where we had less population concentration in urban areas. We certainly had less technology, less digital, less service industry, hard products. It was a transactional based system, first with property tax based on property values, and then sales tax based on actual tangible property sales, which has since evolved but has not kept up with what's going on in other places. At some point, to remain competitive as a state, and this sort of ad hoc basis that we've done it over decades and decades and decades, we've got tax rates, whether it's property tax, income tax, and even sales tax. In none of those three categories are we in the lowest 25 in the country, which makes it very difficult. And it's been time for some time to take a comprehensive look. And so one of the things I want to cover, Jim, and then get your thoughts on is how we're starting to think about what comprehensive tax reform might look like and to what effect the pandemic might have an effect on how we think about it, and also the blueprint process and how that might affect it. So let me talk about that a little bit. Again, the order of the day is, in the current environment, is the last 17 days of legislative session and finding a consensus on property tax relief, tax incentives, and next, which is the UNMC project. That's really, really important. And I put other in there because I'll give the senators who are on listening today space for other. But it's really important to get this stuff done. But as we come out of this legislative session, I think we need to turn sort of immediately, instead of getting back to, age-old battles, really understanding what our post-pandemic economy looks like and how it affects how we think about taxes and spending going forward. Certainly, it's going to affect workforce trends. You can't put 100,000 people on unemployment and then move them back into the economy, hopefully, at some point here, without some dislocation and some changes. And indeed, workforce was our #1 issue going into the pandemic. I have a sense, Jim, that by the end of December, if we take a survey of businesses, they're going to tell us workforce is their #1 issue again. Thoughts?
100% agree.
Yeah, it seems like that, and we're already hearing in certain industries that we're already facing that again. Certainly the revenue trends we've talked about, outside of decoupling or not decoupling, revenues are going to be down. Federal government revenues and state revenues potentially due to lower economic activity. And let's say federal or state revenues are down 5 to 10% when this is all over. Now, what I will say is Nebraska is faring better than almost any other state in the country. And I think the reason for that is severalfold. One, the governor didn't do a stay-in-place order and didn't shut down the economy like they did in some other states. I think our industry mix tends to favor us along the way. And then I think Nebraska did a better job of PPP loans than any other state in the country. Put those three things together, and I think that has a lot to do with why we're trending better than almost any other state in the country. But nonetheless, it'll have an effect. And so we have to ask the question, if we do have for a year or two 5 to 10% less revenues coming out of the pandemic because of economic issues, how do we stimulate that economic growth to really change that curve? We've got the digital economy trends. If anything, the pandemic is going to move people to more online activity, not less. With more people working at home and more people staying home, that digital economy has continued to be very robust during this period. And then we got to start thinking about the economy more and tax and spending more in terms of industries. There's going to be, coming out of this, there's going to be very different levels of dislocation based on industries. And so I think a lot about the hospitality, entertainment industry right now. And you see that in Omaha, Jim, with the conventions and the College World Series and everything that's happened in Omaha. that the amount of damage to the hospitality industry is substantial, and they're a big part of our economy. So it strikes me that if we're going to look at a more fundamental tax reform, we can't ignore what the effects of this pandemic have been. Thoughts?
No, 100% agree. As I said before, we're not going to be able to cut our way into tax reform in the future. We're going to be dependent upon the growth of state revenue as a option to fund any sort of tax relief. I will circle back to the broadening of the sales tax base, certainly as one way to get that done in light of the pandemic and in light of not being able to cut during any point in the future, given that I don't think there's 33 votes to do that. But we have to be cognizant and understand the pandemic economy moving forward as it relates to tax reform, because it's just it probably just made it more challenging than it was even before.
So I'm going to read the slide. I was accused by my staff of being too wordy with these slides, so I will not read the slide, but I do want to take into account not only the pandemic, but Blueprint. And Blueprint really took the look at where we rate in terms to peer states, 14 peer states that look a lot like us and have the same sorts of economies. And on a tax side, we're not competitive either in income tax, sales tax, or property tax. And we do have to be concerned about the effect of those taxes on whether companies stay in the state and whether jobs stay in the state, and also whether companies come to the state and whether jobs come to the state. In order to get there, we need to reform our tax code, control government spending, and take a really hard look at how our tax code does affect economic growth, because in the end, economic growth and opportunity is going to drive not only the ability of the government to fund itself, but whether young people stay in the state, because of whether opportunities are going to be here or not. What Blueprint called for was a nonpartisan study to take a look at, put everything on the table and take a look at it, and then develop a tax code that can produce that sort of economic growth that's going to be needed. In a nutshell, I put it in this little chart on the left at a very high level. If I were looking at policy factors for how we would build a comprehensive tax reform plan now, I would start with the simplicity, fairness, economic growth, the Reagan standards for good tax policy. I would add the Blueprint initiatives, which is the tax code should enhance population growth, should enhance workforce, which goes hand in hand with population growth, but it also should enhance the skill sets of that workforce and the technical training available to those workforce. One of the things Blueprint came out with was that we're, from a technology innovation standpoint, we're near the bottom in terms of things like patents per capita and R&D spending, although that's getting better. The tax code needs to promote more innovation in technology. That's also important to attracting young people to our state, helping communities build more welcoming communities and build their infrastructure. Certainly broadband, I don't need to talk to people about broadband, and then focus on key sectors that are key to our growth. Clearly agriculture, manufacturing, transportation, logistics, healthcare. These are areas where we're global leaders and we have a lot of potential. And then I'd add the COVID pieces, which is what are our most damaged industry sectors. I talked about hospitality. How do we accelerate more digital services? How do we grow digital services and workforce in this state? There's an opportunity to bring Asian supply chains, particularly back to the United States. How do we attract those? And how do we become a more attractive site? Because we've got about a year to year and a half window here to really start attracting businesses that are rethinking where they want to be located. And nothing's going to be more attractive to Nebraska if we have an attractive tax code than all our other advantages. And then the diversity impact of what we do. That's a load of policy factors to try to build into a tax proposal. Simplicity, fairness, and economic growth sounds a lot easier. Am I wrong on this to say that we ought to at least be pulling this stuff in?
You're dead on. And what I fear as I've held this job for the last 8 years, even though we haven't necessarily taken the steps forward to lower our taxes, that's not what this is all about. other states have. And doing nothing, we fall further and further behind from a competitive standpoint. And there's a direct correlation with our income tax and the growth of states. Some don't want to believe that, but the data certainly warrants that. And we've got to find a way to move forward with systemic fundamental tax reform. And I think next session has got to be the opportunity for us to have this conversation.
Yep. So I think what I put up in the top right-hand corner is just, funding becomes an issue because unlike the federal government could pass a tax bill and it doesn't have to be revenue neutral, although they generally try to until recently. In Nebraska, we ultimately have to balance a budget at the end of the day. So when you think about how to fund tax cuts over a long period of time, government efficiency becomes critical to that. And that doesn't necessarily mean tax cuts, but how do we become more efficient using technology and integration of different functions, just like we do in business. Just clearly have to drive economic growth. That's the biggest number in terms of trying to fund something. Modernization of our workforce, technology enablement increases the multiple value of our workforce by at least twofold. And so encouraging a technology enablement and the technology skills of our workforce is important. Broadening the base, we've talked about. Sort of my least favorite thing is tax shifting, is just simply, well, let's pull 100 million out of income taxes and put it in property taxes. Let's charge 100 million more property taxes and apply that to sales taxes. That to me is just sort of putting things in one bucket or another. That doesn't mean that I do think from time to time the state needs to look at property tax, income tax, sales tax, which are the three biggest factors, and think about how those are balanced. So I'm not suggesting that doesn't need to happen, but on an ad hoc basis, I just hate to see money put from one bucket to another. Possible approaches, and this is where I'd be interested in your thoughts. So you know me, I'm an old flat tax guy, so I like flat, fair taxes with fewer incentives, with incentives built into the tax code. I'm not anti-incentives, but I think that at all, because we clearly support incentives, but incentives are productive in bringing jobs and workers to the state. And I think we've done a decent job in past years of having bills that produce jobs and employees that created a return on investment for the state. I think 720 does a much better job of that, the bill that's before the legislature right now. I would rather have the types of mechanisms that are in 720 than what we've had in the past, but I'd be interested in your thoughts.
Yeah, I'm not going to get necessarily in a deep dive in 720. I wish that we had a tax system that attracted the growth and the jobs and the businesses that we want to see outside of incentives. I think you and I agree on that. But I do think 720 is better than what we've had in the past. Absolutely.
And I think the other piece, so as you know, I'm from Gearing, proud Bulldog class of 75. One of the hard parts of any tax system, whether you're just dealing with the tax system or incentives or anything else, is how do we create that growth in the same kind of growth in Scottsbluff we're getting in Omaha? Now, I understand that 5% growth or 3% growth in Omaha is a big number, and 3% and 5% in Gearing is a smaller number. But how do we get that same percentage growth across the state? And part of that is making sure that we are creating opportunities all across the state. The easiest and fairest way to do that, to me, is always lower rates. But that's something that I think is going to be key to ever getting 33 on a big comprehensive tax bill. Thoughts?
Yeah, it's taxing wealth and taxing income is the most destructive tax that you can have. So I agree with you that lower income tax rates is my first go-to as far as trying to create growth and opportunity in the state of Nebraska. But what we haven't done yet in the state, and I don't know if it's a combination of the Platt Institute, the business community, elected officials is we haven't necessarily shown why that's important. And the leadership that probably needs to happen needs to be intensified to show that if we don't do what you and I are talking about, and that's making our rates more competitive to drive growth in our state and opportunity, we're falling further and further behind. And I'm not sure that the folks in Lincoln understand what's at stake if we don't do that.
So I'm going to finish the final comment, Jim. Then anybody can ask us questions using the chat function, and we'd be happy to answer any of those. The one thing I've learned in this job in the last couple of years, Jim, is that our senators are all here for the right reasons, and they're all working very hard to get to the right place. It's not for lack of effort that we're not getting where we're going at any particular moment. I'm going to remain optimistic that we're going to get to 33 on something on all the necessary legislation this year and make that happen. And I'll do everything we can to support that body to make that happen, because I'm always amazed. These are people that don't get paid a lot of money for what they do, and do it because they love the state. And so I'm very appreciative of all the efforts that they make, and hope that we can be good teammates along the way.
I agree. Our job at the Platt Institute is to provide a path forward for policies that are going to grow the state, and we've had some opportunities to do so this legislative session. I think on top of that, we've got to make sure that we conform on the CARES Act and our tax code conforms with the federal tax code, so we are not putting businesses in a position where they can't grow through this crisis. And that's what our role is going to be moving forward. And I hope that we have a productive 17 days once we start on the 20th.
Okay, Jim, I am not seeing any questions in my chat, but it may be, I'm going to ask my staff if they've been collecting any questions while we've been on.
We have. I'll start with the first one. Are you aware of any forecasts or guidance on how decoupling or not decoupling would impact state coffers?
Brian, you want to take that, or you want me to?
Yeah, so the Department of Revenue has performed a preliminary analysis on several selected provisions in the CARES Act, and so it was over 100 million of revenues associated with that. If you selected, basically the NOL items and some of the other items, including interest deductibility. My sense is that was just a 3-year snapshot. It didn't take into account the timing nature of those issues like NOLs, which would simply be used later and just create a revenue issue later. So while I understand for the scorekeeping of current year legislation, moving expenses to another year is helpful in the long run, it's not. Other than that, I'm not aware of any other analysis that's been done to this point. Are you, Jim?
I haven't, and something that I don't think I mentioned when we were talking about conformity, you had asked me about it, is that depending on any decoupling legislation, these proceeds could be taxable by the state. And so that's another reason why we got to make sure that we take that option off the table and make sure that we conform, because that would be double taxation on these businesses that were recipients of these loans.
Yeah, that would not be good. Kristen, other questions?
Yes. So local governments, routinely tell us that individuals don't come in and complain about their tax burdens there at local meetings, and voters routinely vote for bond issues to increase their own taxes. If local individuals don't seem to care about their local spending, why should the state care to limit it?
So I'll take a first crack at that, Jim, and like you, I do think people locally care. It is one of the great fortunes of this state that we have people that really care about their state, they really care about their communities, and they really care about their schools. And that is a strength of this state, not a weakness. And so the other piece of this is from the early constitutional days of this state, it was built on local control and the idea that people have the right locally to vote for whatever they deem to be what they want. So I think even in the property tax legislation that we're talking about now, where we talk about some spending controls, generally speaking, it still allows local communities to vote to create the services and pay for those services as they see fit. The question is, how do we create both a very healthy state and very healthy localities? What we've learned in this pandemic is we're all interconnected in this state. When the pandemic hit, it wasn't just Omaha, and it just wasn't Lincoln, or it just wasn't Lexington, or it just wasn't Grand Island. You could see the ripple effect through the entire state. If anything, I was able to watch how losing a company or having a company in trouble or having issues in one particular town literally rippled through the state, including all the way through Lincoln and Omaha. The urban and rural divide may exist politically, but economically it doesn't. Jim?
Yeah, I think you eloquently took some of my thoughts. I will say that I think LB 103 last year will help the process, adding more transparency to property tax valuation increases to hopefully get more folks engaged. And we're working with Senator Linehan and Senator Ben Hansen on making changes to that to make it even better. So I think people do need to be engaged on all levels. I was an elected official on a local level for 8 years, and I rarely saw people come down to talk about the budget debate when we were approving a budget here in Omaha. And I think that even is more so the case in school districts. So the more that we can get people engaged, but that interconnectivity that you talked about, Brian, is so true. And now we've got the landscape that we just can't get away, that people are asking the state for property tax relief, even though they're not a property taxing entity. That alone shows you the connectivity to school funding and property taxes. And it's critical to get everybody engaged.
Kristen, are there more questions?
There are. So how might you limit education spending without reducing quality, or assure the public that you can limit education spending without reducing quality?
I'll take a first shot at that, Jim, and then since you're the guest, let you clean up all my mistakes. Couple things on that. I think to clarify what I think is being proposed and what we're talking about, and Jim and I, even on income tax bills in prior years, it was the same thing. It wasn't limiting spending in terms of cutting spending. It was always trying to keep the growth in government spending, and it's not just education, but all over, keeping the growth of government spending within something close to what the economy is really growing. Because if the pace of increases in government spending increase much faster than the economy is growing, you are inherently raising people's taxes every single year. And the example I always use, and I'll give him credit for it, some of you may know I ran for governor in 2014 against Pete Ricketts, and he demolished me. But at that point in time, I was proposing a 4% target for growth of government spending, and people looked at me like I was crazy. To Pete's credit and to the senator's credit, the state has done much better than that since 2014, and they've really done an excellent job at the state level of controlling the growth of spending. And so I think as a state, both at state and local level, it's appropriate. This is exactly what we would do in business in a time where we know that revenues are difficult. We would target our spending to try to keep the growth rates within something close to what economic spending can be. Does it necessarily have to diminish the quality of education? In the business world, every one of us has to get better, cheaper every year, using technology and using better processes, and that's the nature of the beast in business. I see it every day in education. It's not that it's being done, and I think you can see, President Carter at the university is already headed down that track with the university, really trying to make the university better, but also more efficient. I see it in some K through 12 schools, a lot of them doing the same thing. So I don't think dollars necessarily in terms of restricting growth means you have a lesser quality of education, but everybody's got to be at the table and be part of that conversation. And that's where I hope we get this year. Jim?
And nobody's talking about making cuts to schools. We're talking about having a reasonable amount of growth in the spending of schools over time. And that it's not just about schools, it's about counties and NRDs and the state and cities across Nebraska. if we have unsustainable growth in spending at the school level, there's no shot of property tax relief. There's no shot of tax relief in general if we're doing that at any level. And so I think that's what Brian and I are talking about when we talk about controlling spending. It doesn't mean cuts. It's just trying to keep it a little bit under the growth of the state so we have a shot of providing the tax relief that the state needs.
So we're bumping up against our time, so we'll take one more question. Maybe we'll end with a fun one for two folks who like taxes. Back in the day, the Nebraska income tax used to be a percentage of the federal income tax. What are your thoughts on that?
Well, as a flat taxer, if the percentage were low, I would love it. It would be simple. It would be generally fair, and it would. The other part of it is when you raise taxes, people would know you raise taxes because it would be a rate increase. But the practical reality of that is Nebraska's economy is not exactly like the federal economy. And what the Ways and Means Committee and Finance Committee and Congress does in enacting tax bills reflects the national economy. There are things unique about our economy like ag, like our transportation industry, like our manufacturing industry, that I think we'll always need to have a separate Nebraska tax code to a certain point. But I love the idea of getting down to postcard returns someday, both federal and state.
I agree 100% with what you said, Brian, and I really don't have anything else to add.
Well, with that, I want to complete this by just thanking my good friend Jim Vogel, who the Platt Institute does great work in research and analysis that I know I enjoy reading and rely on a lot. And Jim, it was great of you to spend this time with us today, and I just want to tell you how much I appreciate it.
Well, thanks, Brian, and I look forward to working together with your members as we try to provide more relief for Nebraska businesses and make Nebraska a more competitive place to work and start a family.
Perfect. And thanks to everybody for spending the time today. Really appreciate it.